After 10 consecutive interest rate hikes, the United States Federal Reserve hits the pause button. We'll discuss what that decision means for the U.S. economy and its global impact. Hello, I'm Anand Naidu, and this is The Heat. For the first time in over a year, the U.S. Federal Reserve said it would hold its key rate steady and not raise interest rates. But Fed Chairman Jerome Powell cautioned the job of lowering inflation is unfinished. He signaled the likelihood of 2 more rate increases this year.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
CGTN's Owen Fairclough begins our coverage with this report.
A breather for the U.S. central bank after some of the most aggressive rate hikes in years. The Federal Reserve opting not to increase its benchmark interest rate any higher than up to 5.25% after 10 successive rate hikes when inflation began to spiral. But after topping 9% in June last year, those price rises have dropped. Eggs, one of the most visible symbols. The average price of a dozen now just over $2.50. That's almost half their January peak. And it's arguably a welcome breather for Fed Chair Jerome Powell, who had to firefight a potential banking crisis when 4 regional lenders collapsed in the spring, as well as prepare for the consequences of the U.S. defaulting on its debt, though this was averted. But Powell is cautious about pausing rates for too long, partly because inflation has dipped and then risen again several times over the past year and was 4% at its latest count. Owen Fairclough, CGTN, Washington.
For more now on the U.S. Federal Reserve's decision, let's bring in our panel. Joining us from London is Klisman Murati. He's the founder of Pareto Economics, a global world affairs research consultancy. From Ann Arbor, Daniil Manaenkov is the head of the U.S. forecasting at the Research Seminar in Quantitative Economics at the University of Michigan. From New York, Liang is the Endowed Chair of Economics at Willamette University, and Anthony Chan is the former chief economist for J.P. Morgan Chase & Company in New York City. Thanks, everyone, for being with us. Anthony Chan, as we just heard from the Federal Reserve Chairman there, interest rates will be left where they are for the time being, but he did signal that there could be interest rate hikes later this year. He called it a skip, although it was very reluctant on his part to describe it in that way. But given that inflation continues to persist, why postpone an interest rate hike? What do you make of this strategy?
Well, I think he wants to see if somehow they can jawbone the financial markets into tightening those financial market conditions a little bit. And that will mean that the Federal Reserve doesn't have to raise rates as much as they would have in order to slow down inflation. Remember that by raising rates very aggressively, they risk breaking something or causing more financial market turmoil. We saw what happened with the banks. So I think it is their goal to raise rates, but to raise rates as little as possible to get the job done of controlling inflation.
Anthony, Powell also pointed to the difference between core inflation and the broader measure, which includes things like food and energy as well. But what is it in core inflation that's driving the rises?
Well, right now we know that one of the big factors, of course, is housing. We know how that's computed in the consumer price index, and even to some extent, and even in the personal consumption deflator. Those numbers come in with a little bit of a lag. The real-time shelter numbers, especially rent, are rising, but they're rising a lot slower. So that eventually will show up in the actual numbers out there. That's why Chairman Powell likes his supercar number that actually excludes housing services. So they're looking at the services component mostly and trying to look at everything, but at the same time, they're doing their best to not raise rates so aggressively that it will end up causing more severe pain and discomfort for the U.S. economy and not raise the unemployment rate as much. And in fact, we saw some encouraging news. Not only did they raise the GDP forecast, but they also lowered the terminal rate for the unemployment rate for the end of the year.
Daniil, great to have you with us. Welcome to the show. There's a report from the U.S. Bureau of Labor Statistics which shows inflation actually eased for the 11th consecutive month. Last year, it peaked at 9.1%, as we heard. That was a 40-year high. Now it's down to 4%. But things like groceries, new car prices and rents are still stubbornly high. What will you be looking for that would give us an idea of where the economy is going, where interest rates are going later this year?
Right. Thanks for having me. So, as Anthony mentioned, the super core is what markets and we are focused on, because I mean we know that housing prices, housing rents have been rising, but the recent real-time data shows that rents are cooling off. So everything else that is happening in the economy, in the service sector, is what's the most important. So think about what accountants are charging for their services, what your dry cleaning costs. So the super core, that is core inflation without the impact of rents, is what I'm looking at the most. And there are two measures of this. There's the CPI, which we got the other day, but there's also the PCE, which is broader measure. And they are moving a little bit in different directions, but the broader story is the same. They remain pretty stubbornly high. And you can think about those as the most sensitive price measures to what's happening to wages. And wages are probably the key to this measure of inflation, and we haven't seen much of a deceleration in the rate at which wages are rising. So we're going to be looking at inflation, but we're also going to be paying attention to what is happening in the labor market, because it's hard to envision wages slowing down without some broader softening, and that's just not happening so far.
And Daniil, what are your thoughts on the Federal Reserve holding the rate right now, but indicating that there could be rises later?
Right. So, I mean, I agree with Anthony. They would love to raise rates as little as possible. But there's another point, is that for the past several years, at least, the Fed tried to telegraph what they're about to do in advance to avoid surprising the markets. And they've been preparing the markets for this ultimate pause for many months now. We got some data recently which went counter to the preparation. So they chose to pause, but to signal that more rates are coming. So I don't know if it was a successful strategy. Looking at the markets, there was plenty of volatility today. So maybe it didn't work, but they try to stick to what they've been doing before, and not to change things without telegraphing their intentions in advance.
Klisman Murati, let's look at the Eurozone. Germany's economy contracted for 2 consecutive quarters. That meets one of the definitions of a recession. The country is also plagued by high interest rates. What impact is this going to have not only in Germany, but seeing that Germany is one of the drivers of the Eurozone, what impact could it have in the EU as a whole?
One thing we have to remember, Adnan, is that the impact of any economy on any other economy is based on two very important things. The first one is the importance and scope of that economy, and also how connected that economy is to the target economy that you're looking at. So when you're looking at cost, at the analysis between these two options or these two entities, it's very clear that being the driver in Europe, Germany has a very substantial place in the EU economy as a driver of growth, because every other economy in the Eurozone has been stagnant over the last couple of years. Now they've gone into a recession. Soon we'll probably see stagflation in that economy if things continue the way that it's going. Alongside that, it has externalities, which it's trying to fight, be it geopolitical risk, right? Be it a tumultuous energy market. So they have a lot of things that they're considering and a lot of strategy that they need to implement in the right way, which is very difficult.
Yeah, I'm going to get back to that energy market in a moment, Klisman. But one other thing, and that is the European Central Bank will be meeting on Thursday. What are your expectations?
Well, it's hard to predict these things, but the U.S., what Jerome Powell is doing, I think every other central bank is looking at. because of the importance, as I mentioned before, the systemic importance of the Fed. And looking at what the Central Bank of Europe will do, I think they'll again do what is best in their interests because their mandates are different to what the Fed is. So they're going to try their best to manage the situation as best they can. I think they will probably raise rates as things go because the fundamentals of the Eurozone and of America are very, very different. But also one thing I want your audience to remember is back in 2021, Jerome Powell mentioned that this inflationary environment was transitory. So every decision made up after that point was based on that theory. Turns out it wasn't transitory, and now the Fed has played catch up with 9 months of inaction basically on the US economy, and now they've ramped up the interest rate 10 times. They're waiting now to see what happens, but I think it's 9 months too late, and this is causing Jerome Powell to now catch up on his bad predictions at the beginning of this crisis.
Liang, great to see you. First, I have a question about the Federal Reserve announcement that was made. We heard that house prices are rising, which could lead to a slowdown in demand for new construction. So I'm wondering how this would impact China, which is one of the world's biggest suppliers of building materials.
Yeah, good to talk to you, Anand. So first of all, I think, this rental cost increase, the latest number is about 8%. That is a very tricky issue because as you mentioned, right, with the hiking interest rates, the supply of housing tends to fall. And so that could even worsen the problem of, rental housing price increase. So that would, pose a difficulty for, continue to fight inflation. And also hoping that this pause could actually lead the Fed to really rethink, right, given the two uncertainties that they have faced with. One is, how raising rates may not really dampen the labor market that much. So there's uncertain impact of rate hikes and labor market performance. And the second uncertainty is, how the labor market stays strong, but inflation has steadily gone down, as you pointed out. Mm-hmm. Now, for China, I think, this has been a reality that export demand has been softening. When we look at the May number, for example, China's exports actually fell by 7.5%. So China has been embracing, that reality and understand that you need to pivot towards domestic demand. Retail sales have been going up and stay relatively solid, increased by 18.4%, the latest number. So I think, for China, the global weakening demand is going to be a big challenge. So the key really is trying to focus more on domestic demand. Central bank has just, slightly lowered the 7-day repo rate. And I think that is a signal that there are more policy tools down the road to try to help to pop up domestic demand.
Right, and Liang, the World Bank has actually issued a report in which it's saying that the global economy is dramatically slowing down as higher interest rates are beginning to take a toll both on developing and advanced economies. Let's listen to Elitsa Mileva, who is the senior economist at the World Bank.
This is mainly due to the fact that financial conditions globally have tightened. Monetary policy in major economies continues to be tight in order to reduce inflationary pressures. And even while this is happening, inflation remains stubbornly high in the world, above, for example, central bank targets. And so these are challenges that will weigh on global growth. And in addition to that, the World Bank now expects global trade growth to be weaker compared to last year.
Right, so overall, global growth will slump to something like 2.1%. And I'm wondering how that would impact China, especially demand for its exports.
Right. So I think demand for exports will continue to be weakened. But, that said, I think, there's still regional trade that is being, that has been very vibrant. China's exports to the United States has fallen by, 5.5%, but its exports to the ASEAN countries and also to Europe have gone up. But that said, again, I think, for China, the best strategy is, to utilize the broad domestic markets, but then, of course, trying to increase its, footprint in the global supply chain, upgrade its industry, so then, it will continue to, have high demands of its exports. But so far, I think, China's recovery has been really fueled by domestic expansion in the service sector. But again, I think very interestingly from the World Bank's statement just now, we see the collateral damage of the U.S. hiking rates to fight inflation is that puts many countries in grave difficulties in terms of their debt burdens and in terms of their slow growth due to the weakened global demand.
Anthony Chan, so far the United States has avoided a recession, but several very big companies are expressing their concerns over what is going on right now. We've seen job cuts in the tech sector, and this is now moving into manufacturing, into media, into financial services. We're seeing job cuts there as well. This is what Jerome Powell had to say about that. Let's listen.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
So, Anthony, what is your assessment right now of the strength of the labor market?
I think the labor market still remains fairly strong. Of course, initial unemployment claims have been rising, so it would suggest that even though it's strong, it's getting marginally weaker over time. We also know that economic growth was upgraded by the Federal Reserve, but still 1% growth this year is still very, very weak. One of the reasons why we've seen no recession either in 2022 or so far is all that stimulus that took place during the global pandemic. We know that a study that came out of the Federal Reserve showed that early on we had more than $2 trillion of excess savings. Now that number is down to about $500 billion and will run out by the end of this year relative to trend. So that would mean that the potential for a recession probably comes in sometime in the first quarter of 2024, which is, I think, when the burst of rising short-term interest rates and the lack of excess savings can cause the U.S. economy to move into a recession. But for the time being, I think the U.S. economy is holding fairly strong.
Daniil, the U.S. Treasury says that the U.S. banking system is on a solid footing, but we did see failures earlier this year. What are your forecasts in the banking sector, and what could happen if the country gets into a recession?
Right. So in terms of what could the Treasury say about the banking system, I'm not exactly sure that they would be in a position to say anything else, because if they do, they'll probably unleash a run for cover. So in terms of the banking sector itself, there is still plenty of stress going on. If you look at the weekly statistics that the Fed publishes, there is still an ongoing flight of depositors which are moving their funds out of the banking system, which doesn't pay much interest, into like money markets and maybe short-term treasuries. So it's not doing great. If the Fed has to raise rates much higher than what they said today, that's going to exacerbate the issue. And there's a slow-moving building problem in the commercial real estate, where a lot of like big businesses are basically choosing not to renew their leases or just to default on loans, and that's going to come back to the most stressed part of the business of the banking sector, which is smaller sized banks, which have outsized percentage of their assets devoted to this commercial real estate. So if there is a significant increase in interest rates, that's just basically going to supercharge the issue. If there is a recession, it all depends on what the Fed does and how quickly they lower rates and how much they support the banking system. So we are kind of on the cusp of two different scenarios at the moment. So I certainly think the recession later this year is a possibility. But it's also possible that the momentum carries us forward, and there is the so-called no lending scenario, where just inflation continues, the Fed tries to raise rates but doesn't raise them too high, and growth continues. So it's really difficult to read, and like what Anthony described is like a good median between the two. Which one happens? I'm not exactly sure at this point.
Klisman Murati, in May, factories in the United States as well as across the Eurozone reported a decline in demand for manufactured goods. I mean, would this lead to a slowdown? What will high interest rates do?
That's a very good question. That's something I've been trying to grapple with myself during this very tumultuous period. Look, there's two things that I think are at risk of causing defaults across the industrial sector. Okay, the first one is that debt, essentially. The first one is debt, meaning as interest rates rise, the cost of borrowing also increases, which means banks, because of the risky situations of who they've lent to in the past, may not be willing to restructure loans, which means companies may go bankrupt. Okay, and the second one is the fact that we have, as you mentioned, reduced demand due to rise in interest rates, and also fundamentals like COVID, which during the pandemic, people were going into the offices, and the local economies in the inner cities, for example, were declining, which would cause defaults also. So rising rates has the benefit of making things more expensive, which slows down the economy, but has the negatives of having the cost of borrowing go up, which means this may not be able to be serviced by specific industries or companies which are over-levered and are unable to pay. And even worse, banks are unwilling to restructure these debts due to the risks that they face.
And looking at the situation in the United Kingdom, where you are, it reported very high employment this week, but still there is a shortage of something like 1 million workers. And in fact, the economy is only expected to grow by 1% according to the OECD. What is the situation there?
Well, the situation in the UK, I think, is that the central bank of the UK, Bank of England, has had very negative forecasts of what to expect in the UK, which were proved wrong. The resilience of the UK, although not back to normal levels, has been surprising to many commentators and many active players. Right now, I think there is increased demand in the services sector. People are spending money, albeit still cautious of the long-term uncertainties that the world faces. COVID is no longer a big issue like it was in the past. Energy prices are coming down. Gas prices are coming down, as we can see on a daily basis. Things are becoming cheaper for essentials, albeit not at the same rates pre-COVID and pre-war in Ukraine. So I think what's happening now is that both the government and the central bank are trying their best to work together to avoid what happened under Liz Truss's government, where we had excess spending and we had very inconsistent policies between both the central bank and the government. So as it goes now, the UK is trying to find, again, post-Brexit trade partners to sort of fill the demand that UK businesses have to sell abroad. The US isn't really playing ball in that sense, although they're playing ball in other ways. But they're trying to find export markets, export goods, so that they can remain afloat during this tough period.
Liang, new electric car sales have shot up by something like 60%. That was in May. For China, how critical is this sector?
Well, I think the sector is going very well because, as we know, that China has been really promoting the e-industries, the EV and also other energy efficient and new energy vehicles. So I think China has the competitive advantage in this sector, and it's a whole complete, supply chain. Not only is able to attract, people like Elon Musk to invest now a second factory for Tesla in China, but also, very vibrant sector in terms of, battery production. So I think, that is a bright sector that will continue to grow and grow strongly. And it's not just about EV, but again, it's the whole green industries of the supply chain that we have seen China is really climbing up and dominant in the industry. Like, for example, battery cell production, China now occupies 79% of the global market. So I think that will continue to go strong. Now, going back to this idea of rate hikes in the United States, I think that definitely would in many ways dampen the U.S. economy without really, I would say very significant impact on inflation. I mean, we see that the labor market, for example, the wage growth has slowed down from 4.4% to 4.3%, and that is barely keeping up with inflation. So hold this idea about slowing down and to crash the labor market, to fight inflation, it seems to me is really a wrong sort of focus, especially when you think about, the Kansas City Fed just released a research, and they found that the corporate profits account for 60% of inflation back in 2021. So this idea of hiking interest rate to slow down the labor market, slow down wage growth in order to fight inflation, I think is really missing a big point.
And Liang, looking at the relationship between the United States and China, I mean, there have been tensions. Those tensions have been rising. The trade tariffs are still in place. But recently, we've beginning to hear a change in tone. I mean, we heard the Treasury Secretary, Janet Yellen, say that it's in the U.S. interest to maintain relations with China. She said Americans benefit from cheaper Chinese goods. And of course, this weekend we have the Secretary of State, Antony Blinken. He'll be traveling to Beijing for meetings there. What do you see? Are these signs of a thaw in the relationship, perhaps a defusing of tensions?
Well, I think that remains to be seen, but it's clear that the reality shows that wholesale decoupling is not materializing. The U.S.-China trade is still rising. The U.S. investment in China, especially for some of the tech industries, are still rising. So this whole idea of decoupling is not happening, and it's not going to be desirable for the United States. I think we're now past the peak of inflation, where the pressure for the United States to work back on its tariffs on China has been passed. So now, the U.S. is probably not going to think about, well, should we, lower the tariffs rate in order to fight inflation back home? But that said, I think their now rhetoric is the so-called de-risking. So this idea that we still need to, have sort of limited decouple, right? The so-called small areas with high fence in terms of the high-tech sector. But, I think that is still a very difficult idea to implement. And also, it's not clear that China has the appetite to accept this whole rhetoric of de-risking, when in reality,
right,
the U.S. still seem to contain China's growth, especially in the tech sector.
Okay. Klisman, I've got about a minute left, but you mentioned the volatility of energy prices in the Eurozone. We've just heard, apparently, the Ukrainian counter-offensive has started. There's not much talk from the NATO partners in Europe, as well as the United States, about ending this conflict very soon. To what extent is this conflict hurting the economies of Europe, given that volatility that we talked about?
I think it's not a case of it hurting, because the Ukrainian economy isn't that wrapped up with the European economy if you exclude exports of grains and other sort of commodities. I think what this war is doing is focusing resources, military resources, to Ukraine, with also the uncertainty of what extra weapons to Ukraine would mean for the battlefield, and also what would mean for the long-term security of countries which go to Ukraine.
Okay, we're going to have to leave it there. Thanks to all of you for being with us. That is it for this edition of The Heat. I'm Anand Naidu in Washington, D.C.
The nature of business is to bring value. Business activities in Europe, Asia, and the U.S. reach consumers globally. Trade, manufacturing, energy, high-tech, real estate, consumption. We give an expanded view on global business and how it covers, influences, or relates to the whole world. Global business, only on CGTN.